Hello everyone, welcome to today's video. My name is the Smart Money Technician. In today's video, I will be teaching you how to get your daily bias using quarterly theory. Now, before I begin this video, I know that many of you have watched daily bias videos, mainly taught by the Inner Circle Trader, but I can assure you that in this video, you are going to be getting a fresh perspective because the method that is used to get daily bias, in my opinion, is rather subjective, but the concepts that is taught in this video are more definitive and objective because we are looking at very specific signatures in price that allow us to get a daily bias. So welcome to the video and let's get into that. Functions of a crack in correlation. There are two functions that a crack in correlation is used for. One is to gauge price reversals or retracements, and the second is to gauge strength and weakness of an asset. In today's video, we are going to be focusing more on price reversals and retracements, but not so much on gauging strength and weakness of an asset. So the first type of cracking correlation that we are going to be looking at is the TPD by Jacob Speculates. So you guys can go and watch the video of Jacob Speculates for TPDs, where he goes into extreme detail. But in this video, we're not going to be going too much into detail. We're just going to be telling you what the TPD is. So over here, you can see that we have in S&P 500, we have a bullish candle over there, right? On this candle that I'm pointing at, it's a bullish candle, whereby in NASDAQ, it's a bearish candle. So we're going to call this candle candle number 2. The candle that comes before it, that will be candle number 1. The candle that comes after it will be candle number 3. So for a TPD, we're looking at the close of candle number 1 and the opening price of candle number 3. And you can see if we drew an imaginary line, you would see that it slopes upwards, whereby over here it slopes downwards. So that is a crack in correlation, and that is a TPD. And whenever you have this in price, you can expect to see a reversal or a retracement. The second cracking correlation that we are going to be looking at is sequential SMT by Trader Day. And many of you know what sequential SMT is. It is basically when we have in one asset, in this case S&P 500, we fail to take out the highest high of the previous quarter, while in another correlated asset, in this case NASDAQ, we do take out the highest high of the previous quarter. This is sequential SMT, and whenever we have this, we can expect that price will reverse. Okay, so the next thing that we will be looking at is gauging the reaction of a fair value gap. Now, over here, if you look closely, you can see this is the weekly time frame, and in the S&P 500, you can see that we trade into the fair value gap, and then we close above the 50% of that fair value gap, whereby in this asset, we traded into it and we closed below the 50%. In order to predict how price is going to react of a fair value gap, we look at where it closes. Because the S&P 500 traded into it and closed above the 50%, we would then infer that price wants to continue bullishly. Had all three assets closed below the 50% of their fair value gaps, we would then infer that price wants to continue bearishly. Okay, so we just need one of them to not close below the 50%, and that is enough for us to say that price will continue bullishly. So once we see something like this on the lower time frame, we are going to look for cracks in correlation that support this idea. Okay, so let's go to the next slide. And the main thing that you need to be able to determine your daily bias is you need to spot a true weak reversal. Okay, so a true weak reversal is when we have a sequential SMT on the weekly or the monthly cycle, and it is confirmed by another sequential SMT or a TPD. Now, I really urge you guys to really go and back test this because it comes in so many variations and sequences, and I cannot cover all of them in this video, but I will try to mention a few. So, for example, if you had a monthly cycle sequential SMT and then it is confirmed by a weekly cycle sequential SMT, that can be seen as a true weak reversal. Or you could have a weekly cycle sequential SMT and then a daily cycle sequential SMT on the lower time frame confirms it. That is can be seen as a true weak reversal. In fact, you can have a higher time frame TPD and then a lower time frame sequential SMT confirming it. That can be seen as a true weak reversal. You could even have a scenario where you have a monthly cycle sequential SMT and a TPD on the very same time frame confirming that sequential SMT. You will then have a true weak reversal. So if you listen closely to what I'm saying, I'm basically saying that in order to have a true weak reversal, you need at least two cracks in correlation, one of them being a sequential SMT and the other one either being another sequential SMT or a TPD. And let's get into the video to show this. So over here we are on the daily time frame, and what happens on the daily time frame is that we have a TPD form over here. If you look closely at candle number 3 the opening and the close of candle 1, you will see that that is indeed a TPD. Now, whenever you have a daily time frame TPD, you can then expect a weekly cycle sequential SMT to take place. It is like a hint that a weekly cycle sequential SMT might take place. So over here, once we have this daily time frame TPD, that's one cracking correlation. Then if we go to the 1 hour time frame, you can see over here that we have a weekly time frame sequential SMT, because the low of Friday is failed to be taken out on Monday in S&P 500 and Nasdaq, but in Dow Jones we do take it out. This then confirms that daily TPD that we see over here taking place, making what we have here two cracks in correlation, qualifying it as a true weak reversal. Okay, so when this happened, if you actually look much more closer, you will see that this low over here on Friday was also the low of the previous week, and on Monday we took out the low of the previous week, meaning that this is also over here a monthly cycle sequential SMT. So with this alone, you basically have a weekly cycle sequential SMT and a monthly cycle sequential SMT taking place simultaneously. That is what we call a colliding sequential SMT, when two sequential SMTs take place simultaneously at the same time. If we had just this alone, this would be enough for us to say we have two cracks in correlation, we have a true weak reversal. But we also have that daily TPD, which is now three cracks in correlation, which is even a higher probability. So we have established that we have a true weak reversal that is in play. Once you've spotted your true weak reversal, that's the hard part. I wouldn't even say it's hard to spot the true weak reversal, but half of the battle is done. The only thing that you now need to do once the true weak reversal has been printed into price is go on the lower time frame cycles and use cracks in correlation and constantly just trade in that direction on each trading day. So over here we have the true weak reversal. So on Monday, during the New York session, on the daily and the 90-minute cycles, we are only going to look for a sequential SMT there to go in line with this particular direction. So let's look at the lower time frames of what happened, because now we have our bias in play. So if we look closely over here, you can see that right here we have the lowest close of the London session. We are M15 right now. So we failed to take out the lowest close. We failed to tap into the lowest close of the London session during the New York. As you can see over here, this is where the New York session starts. But in the Dow Jones, we do open up and rally or trade down into the lowest close of the previous London session. Whenever you have this, where one asset touches the lowest close of the previous quarter while another asset fails to do that, that is known as rejection block sequential SMT. This is a sequential SMT that is not too high probability. So whenever you see this, it is advised that you wait for a TPD to confirm this, or you wait for price to break structure and form a breaker and a fair value gap, and you can enter based off of that. So over here you can see that price breaks the high over here. If you look closely, there was a high right there. Price breaks the high and then forms a fair value gap. Price trades back into the fair value gap, and you can enter on that fair value gap, put your stop loss slightly below, aim for a risk to reward of 1:3 as a day trader. Okay, so that is how you would have entered using the daily bias for Monday. On Tuesday, nothing changes. We have the true weak reversal already in play, so we are going to be bullish again. So whenever you are trading and your true weak reversal has already taken place down here and price expands in your favor that day, the next day you are looking for price to either consolidate or retrace. So on Tuesday it retraced, and then we will expect an expansion back in the direction of our bias. On Wednesday it consolidated, and then we would expect an expansion in the direction of our bias. So when you see price retracing, you go to the lower time frame cycles, that is the daily cycle or the 90-minute cycle, and you look for a crack in correlation there that is in line with your bias, and you trade based off of that. So on Tuesday what happened is that we had a 90-minute cycle sequential SMT. As you can see over here, I just drew this to represent the 90-minute cycle, and as you can see, we have a 90-minute cycle sequential SMT over here. And the reason why I am viewing it through the lens of the M15 is because the breaker and the fair value gap forms on the M15. So there are times where the 90-minute cycle, which is based off of the 5-minute time frame, will not print the entry, but one time frame higher is going to print the entry. So over here you have the fair value gap. You enter, put your stop loss slightly below it, target 1:3, and that is how you would trade a continuation of your daily bias that is in play, because the true weak reversal has already formed. And then on Wednesday, the same thing. You go to either the daily or the 90-minute cycle, whichever one gives the cracking correlation. You wait for your cracking correlation, you wait for your entry. So over here we had a daily cycle sequential SMT, and keep in mind that this entry time we're always going to trade during the New York session for indices. So we had a daily cycle sequential SMT, and in this case it was also confirmed by a TPD. So whenever you have a sequential SMT and a TPD forms confirming it, you don't need to wait for price to break structure and give you that fair value gap. You can enter right as you see the TPD form and put your stop loss below the TPD. But if you are conservative, you wait for the breaker over here and the fair value gap, and use that, and you target your 1:3 as a day trade. So you have seen how we have used Monday, Tuesday, and Wednesday to get a trade in that was based off our daily bias, because our true week reversal has been placed into the market. Now, what happened on Thursday? So every day you need to do analysis to see what the market is doing. On Thursday, we then got a monthly cycle sequential SMT. So over here, this is the high of the previous week. We took it out in S&P 500 and NASDAQ, but in Dow Jones, we failed to take out the high of the previous week. So what did I say? A true week reversal is, it is either on the weekly or the monthly cycle. In this case, it's on the monthly cycle. Now, you will need another crack in correlation to confirm this. So if you look on the 6-hour time frame, there was a 6-hour TPD. Now you can backtest the 6-hour TPD. Anytime you see a 6-hour TPD, it usually causes like an important turning point in the market during the week. So it prints a turning point in the market during the week, and you can use that to trade in line with a new bias. So because we saw the monthly cycle sequential SMT and the 6-hour TPD going into Thursday, we are not going to keep the same bias, because that monthly cycle sequential SMT was confirmed by a 6-hour TPD. At the same time, if you looked at this time, CPI was taking place on Thursday. Now you can go and backtest this for yourself. Whenever you see CPI taking place on Thursday, it usually is a reversal. Like, you will see the high of the week form. So over here we have the low of the week form. Over here we have the high of the week form around here on Thursday when CPI came out. So how would you have traded this? Now, before I even go to the next time frame, I want you to remember what we had over here that caused the true reversal here. We had a daily TPD, we had a monthly cycle, and a weekly cycle sequential SMT. Over here, we have just a monthly cycle sequential SMT and a 6-hour TPD. So that tells you over here we have more going for us. So this over here is not going to be a reversal. It's going to be a retracement, right? So whenever you have more cracks in correlation that are on a higher time frame than this one, because here we have a daily TPD, here we just have a 6-hour TPD. A daily TPD is more powerful than a 6-hour TPD. That will mean that this one will just, even though it is a true week reversal, it will just cause a retracement. It will not cause a reversal. But that retracement that takes place, we can, as day traders, capitalize off that short-term bounce that is a retracement. So let's go and see what happens. So on Thursday, during the New York session, which is the time we trade, we get a daily cycle sequential SMT, and then we had price break structure and form the fair value gap and breaker. Now, whenever you see that the fair value gap is rather large, it might not give you a precise entry as you wish, especially the fact that you have a long wick over here. And if you watched the previous day trading video that I taught, you would see that I said that anytime you have a long wick, just place your stop loss above the midpoint of that wick, because price may reach into a deeper premium, which is what happens over here. So had you placed your stop loss the right way, you would be able to capitalize off this trade, right? So that's Thursday. Now, if you look at Friday, you will see that Friday was very choppy. Whenever you have Monday, Tuesday, Wednesday, Thursday, 4 trading days out of the entire week, giving you clean setups, they have to give you a day that is very choppy and low probability, because they understand traders' psychology and how a trader will be very confident. So on this day, you are advised to skip, especially if you already had 3 winning trading days. I wouldn't even have traded on Thursday, but if you had to trade on Thursday, that was the bias going into Thursday. So with that being said, in summary, it is very simple. All you're doing is waiting for the true week reversal to take place, and you can go back into the video and see what I say a true week reversal is. Once you have your true week reversal, it's over. That's it. You just simply go on the lower time frames every day and trade in line with that bias. just waiting for a cracking correlation to support your bias. That's it. So some of you are wondering how Day has been accurately calling the bias, calling which direction the market is. So this is literally it. All that is required of you is to go into your price and back test this and see the different cracks and correlations that happen to form a true week reversal, because it's not exactly as I gave it in this video. There are multiple sequences, but once you have backtested and exhausted all the different sequences that it comes in, it's over. It's not going to happen in a way that is new to you, because it's only a limited amount of cracks and correlation that the market can do to give you a true week reversal. That's why it's important that you go and backtest this and note all the different variations it takes place in. And once you've had that, you know that all you have to do is just wait for a true wick reversal. Once the true wick reversal is there, simply just straight line with the direction. That's it. So with that being said, thank you for listening to today's video, and I will catch you in the next one. Make sure you like, comment, and subscribe, and yeah, we will talk.